Welcome to the deep dive. We're here to break down the research you shared, extracting the key insights. Today, we're tackling Tyler Technologies, ticker TYL. Yeah, this is the company essentially building the digital plumbing for state and local governments all over the U.S. So, our goal today, unpack the arguments, the bull versus bear case for this giant in GovTech. The analysis date was October 9th, 2025. Stock closed at $517.57. And here's the core tension, the thing we really want to get to the bottom of for you. Our own modeling puts the intrinsic value around $535 a share, barely above where it's trading. It's like the market can't quite decide. It sees the good, sees the bad, and has priced it, well, almost perfectly in the middle. We need to figure out what could tip the scales.
Exactly. That narrow gap is really telling, isn't it? It suggests the market gets the success story. I mean, it's undeniable, but it's also factoring in some very real risks. So we'll use the research stack you gave us. We'll dig into the business model, management, financials, the market, the risks, all of it. See what shakes out.
Okay, let's start with Chapter 1, Business Analysis. The foundation. Tyler's defining trait really is that laser focus. Since 1998, it's been only public sector software, no chasing shiny objects elsewhere, just governments.
And that focus really paid off, especially during their big shift. They moved quite successfully, I'd say, from selling, old school on-premise software licenses to a modern cloud-first model, software as a service, SaaS subscriptions. That's the game now.
And the numbers show it, right? Recurring revenue is huge now.
Oh, absolutely. Over 84% of total revenue is recurring now, based on fiscal year 2024 numbers. And if you look just at subscriptions and the related payment processing, that's 60% of the total pie. It makes the business incredibly predictable.
And the products themselves. These aren't nice-to-haves. We're talking about things like Munis for financials, ERP, HR, or Odyssey for the courts, case management, e-filing. You can't just, switch that off on a whim. It's core infrastructure.
That's precisely the moat. Think about the pain, the sheer cost and disruption of swapping out the entire financial system for a major city. It's immense. They push this idea, they call it connected communities, basically linking up departments, police, talking to courts to tax assessors, etc. It boosts efficiency for the government. But for Tyler, it means incredibly high switching costs. Once you're in deep, it's really hard to leave.
Which explains that client retention number, 98%. That's just sticky.
It really is. And yet, despite being the clear leader, management themselves estimate they only have about a 6% share of their core market.
And that market is estimated at what? $21 billion?
$21 billion, yeah. So even without finding new markets, just penetrating their existing one offers a massive runway for growth.
Plus, the whole sector is booming. GovTech itself is expected to grow massively.
Phenomenally. Projections are showing it could go from around $615 billion in 2024 to potentially $2.3 trillion by 2033. That's like a 16% compound annual growth rate.
Wow, what's driving that?
Well, it's governments finally catching up, isn't it? Digital transformation, moving to the cloud, needing better cybersecurity, starting to look at AI. It's a wave they almost have to ride.
Okay, so Tyler's position seems strong. You mentioned 44,000 installations, including most of the biggest counties. What about competition? Are the big guys like Oracle a threat?
They're out there, sure. Oracle, SAP, some smaller, more specialized players like Excella or OpenGov too. But the barrier to entry is high. You need deep, specific knowledge of how governments buy things, how they operate. It's complex. Tyler's built that expertise over decades. It's hard to replicate.
All right, so the business looks solid, sticky, in a growing market. Let's move to Chapter 2, Management Evaluation. Who's running the show?
Well, the first thing that jumps out is stability. The CEO, H. Lynn Moore Jr., he's been with Tyler since '98. The CFO, Brian Miller, since '97. That's long-term vision right there.
Decades. And more, before becoming CEO, he actually oversaw something like 55 acquisitions. That M&A experience is crucial, given their strategy.
Right, because acquisitions are a huge part of how they grow, aren't they? Absolutely central. Their capital allocation is all about growth. It's a barbell approach, they call it. Big M&A deals on one side, remember the $2.3 billion NIC Inc. acquisition in 2021, and then heavy internal R&D on the other side. They're projecting, $122 to $125 million just this year on developing their own tech.
And importantly for investors, No dividends, right? And not much in the way of share buybacks either.
Correct. It's all reinvested. Every dollar goes back into fueling more growth. They clearly believe that's the best return for shareholders.
But that growth by acquisition path isn't always smooth. The research mentions some execution issues, some bumps in the road.
Yeah, you can't ignore that. While the overall track record is strong, there have been public criticisms, even lawsuits, over project delays and cost overruns. Illinois and Michigan were specifically mentioned. In the public sector, that stuff matters. Reputation is key. So execution risk is definitely something to watch.
Okay, and tied to execution, let's talk about that confusing return on invested capital data. We saw conflicting numbers.
Yeah, that was interesting. One source, probably adjusted for certain factors, showed a sky-high ROIC, like 149%.
49.
I know. But then another, more standard calculation, put it way down at 6.18%, which is technically below their estimated cost of capital, their WACC, which came in at 7.17%.
So are they creating value or destroying it? How do we square that circle?
Well, I think the lower conservative number likely gets weighed down by the upfront costs of big government contracts and integrating those large acquisitions. It takes time for the value to show up in that specific metric. But the tiebreaker, for me, is the free cash flow. That surge we're going to talk about next shows the underlying economics of the SaaS model are incredibly strong once things are up and running.
Perfect segue. Let's dive into Chapter 3, Financial Analysis. This is a $22.4 billion market cap company. Let's see the engine.
Right, and if cash is king, Tyler's looking pretty royal right now. Revenue growth has been consistent, obviously boosted by that big NIC deal in 2021. What was it, 42.6% year over year?
Yeah, huge jump.
And it's settled into steady growth after that, hitting $2.14 billion in 2024. But the real headline, as I mentioned, is free cash flow. FCF just exploded, up 67.8% in 2024 alone, reaching $604 million. That's the SaaS model kicking into high gear. You see the tangible results.
And the balance sheet, you mentioned M&A earlier. They need firepower for that.
They've got it. It's what you'd call a fortress balance sheet. Debt to equity, it's super low, 0.18. And they actually have more cash than debt, over $250 million net cash position.
So they can be opportunistic buyers if they want to.
Exactly. Even in a higher interest rate environment, they have flexibility. Others might not.
Okay, financials look strong, especially the cash flow. But now the valuation, that price-to-earnings ratio is high, between 68 and 74 times earnings.
It is objectively high, no doubt. 68 to 74 times trailing earnings.
Oh.
That demands growth. But context matters here. First, it's actually below its own 5-year average PE, which was way up near 98.4x. So it's come down quite a bit from its peak frothiness.
Okay, that's important context. How does it stack up against peers?
Well, it's in the neighborhood, sort of. ServiceNow trades much higher, around 118x. Oracle's a bit lower, maybe 65x. So 70x isn't completely out of line for a high-growth, high-margin SaaS leader in a defensive sector.
But like you said before, that 70x multiple leaves absolutely no room for error, does it? It prices in near perfect execution.
Precisely. The market is saying, we believe the story, we see the moat, we see the cash flow, but you better deliver flawlessly. Any slip up on a major project, any growth slowdown, and that premium could compress fast.
All right, that wraps up the fundamentals. Let's shift to part 2, starting with Chapter 4, Market Sentiment. How is Wall Street feeling about TYL right now?
Generally positive still. The average analyst rating is a moderate buy, and the average 1-year price target is sitting up at $688.27. That implies pretty significant upside from the current price, around $517.
So the analysts still see value, despite the high PE. But what about the technicals and recent news flow? That seemed more mixed.
Yeah, the headlines have been kind of a mix, haven't they? You see reports highlighting consistent earnings beats, which is good fundamental bias, but then also focusing on the stock hitting a 52-week low recently, the underperformance. So the sentiment feels a bit conflicted.
And the technical chart confirms that weakness. The stock price is currently trading below both its 50-day moving average, which is around $551.94, and its 200-day moving average at $561.96.
So technically speaking, it's in a bearish trend right now.
Correct. The price action is diverging from the analyst's generally positive fundamental view. That suggests near-term caution from traders, even if long-term holders are optimistic.
Any signs of heavy betting against the stock? What's the short interest like?
Pretty low, actually. Only about 2.79% of the float is shorted. So it doesn't look like there's a large contingent actively betting on a price collapse. Okay, let's move to Chapter 5. Ownership structure. Who actually owns TYL? Well, this is striking. Institutional ownership is incredibly high. Depending on the source, it's between 93% and 98%, We're talking Vanguard, BlackRock, T. Rowe Price. The big players have significant stakes.
That signals huge long-term confidence from the professional investment community. They clearly buy into the durable growth story. But then you look at insider ownership, the management team themselves.
I mean, it's quite low, right? Around 1.1% or even less.
Yeah, very low. And the transaction history over the past year shows way more selling than buying 46 sells versus only 6 buys.
That always raises eyebrows. Is it cause for concern?
Well, it needs context. A lot of those sales are likely tied to pre-scheduled 10b5-1 plans, basically exercising stock options as part of their compensation. That's normal, but it does create what they call a principal agent issue. Because insiders own relatively little skin in the game directly via open market purchases, you as an outside shareholder are relying more heavily on the board of directors to ensure management acts in your best interest.
Got it. Okay, let's synthesize all this in Chapter 6, risk assessment. We can use the SWOT framework, maybe. Strengths, weaknesses, opportunities, threats. Sure. Strength, definitely that 98% client retention, the stickiness, and the fantastic free cash flow generation.
Weakness. The flip side of the M&A strategy, the project execution risk we talked about, the potential for delays and cost overruns, and of course that high valuation premium.
Opportunity. Huge one here is potentially monetizing AI within government workflows. And just the sheer size of that GovTech market growth, the $2.3 trillion potential.
Competition is always there, even if Tyler has advantages. And the big one for any software company, especially in government, is the risk of a major cybersecurity breach. The reputational damage would be immense.
Let's zoom in on the macro threats, because these feel very relevant right now for anyone listening. Interest rates first.
Right. Higher rates directly impact valuation for growth stocks like Tyler. They increase the discount rate used in models like the DCF, making those future cash flows less valuable today. That puts pressure on the high PE multiple.
And inflation. That seems like a double-edged sword.
It really is. On one hand, high inflation can squeeze government budgets. Maybe they delay non-essential IT projects. That's a headwind. But on the other hand, inflation forces governments to become more efficient, right? To do more with less. And Tyler's software is often pitched as exactly that, an efficiency tool, a way to automate and save costs long term.
So inflation could actually drive demand for their solutions.
It's a plausible argument, yes.
Yeah.
It creates a powerful incentive to invest in technology that boosts productivity.
What about geopolitical risk? They're mostly U.S. focused, right?
Mostly domestic, which insulates them somewhat. But the research did note a potential indirect risk. If, say, new tariffs in 2025 increase the cost of servers and hardware, that could raise Tyler's capital expenditures for their cloud infrastructure. It might squeeze margins if they can't fully pass those costs along. It's indirect, but possible.
Okay, that covers the key risks. Let's bring it all together in Chapter 7. Conclusion. So, summarizing the bull case. You've got the undisputed market leader in a niche but massive market. They've successfully transitioned to a predictable, high-margin SaaS model. Their balance sheet is a fortress, and they're riding this huge wave of government digital transformation.
The bear case counters with, that valuation is priced for perfection, leaving no margin for error. There's a documented history of project execution stumbles, which carries reputational risk. And they are vulnerable if government budgets get slashed in a deep recession or a prolonged high inflation scenario.
And revisiting our valuation synthesis, our educational discounted cash flow model suggested an intrinsic value around $535 per share.
Using reasonable assumptions like a 7.5% discount rate and about 2.8% terminal growth.
And the stock price, as of our analysis date, was $517.57, so trading just slightly below that calculated intrinsic value.
Which brings us back to where we started. The market seems to be weighing the strong fundamentals, the moat, the growth runway, against the execution risks and the pressure on that high valuation multiple. It's really finely balanced right now.
Okay, so before we wrap up, here's that final provocative thought for you to consider. Tyler leans heavily on M&A for growth. We know interest rates are higher now, so the question is, will this higher rate environment force them to pull back on their acquisition strategy? Or does that fortress balance sheet and surging free cash flow actually let them press their advantage, potentially snapping up competitors who might be struggling financially? Something to chew on. If you found this deep dive valuable, definitely consider liking and subscribing to Stock Analytics AI. For €4.99 a month, members get priority deep dives. We're actually planning to cover all the S&P 500 stocks over the next few months, and members get first dibs. Or if you just want a one-off analysis like this one, dropping us a super thanks is always appreciated. And the important disclaimer, this analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.